Making real estate inclusive for retail investors. Our moderator for this panel has over 22 years of experience in the real estate sector and is the Associate Dean and Director for the School of Real Estate, RICS School of Built Environment. He is also the founder and managing director of Black Olive Ventures, a new age advisory and asset management company. He has served as the vice president of ICICI Ventures Real Estate Fund and also held senior positions with HSBC, DS Group, Colliers International, and Chesterton Megraj, now JLL. Please welcome Mr. Sunil Agarwal, FRICS Associate Dean and Director, School of Real Estate, RICS School of Built Environment, Amity University. Welcome, sir. Our first panelist is the CEO of Brookfield India Office Parks and manages the office business of Brookfield in India. In this role, he heads all aspects of the business, including operations and construction of 17 million square feet of leasable area on fully constructed basis. He has over 3 decades of experience in deal sourcing, evaluation, closing, and asset management across asset classes. Please welcome Mr. Alok Agarwal, CEO, Brookfield India Office Parks. Joining the panel next is a dynamic, results-oriented leader and one of the forces behind making K. Raheja Corp one of the most respected and leading names in real estate industry in the country today. An innovative thinker with foresight and dynamism, he has led from the front to create milestone identities that have changed both the face of suburban Mumbai and also have created new benchmarks of modern and comfortable living. Please welcome Mr. Vinod Rohira, MRICS, Director, K. Raheja Corp, Private Limited. The next member of this panel is the business head for DLF Office Business Pan India, driving an operational portfolio of corporate offices, IT parks, SEZs at multiple places. His operational responsibility includes leasing, branding, client relationships, portfolio management, and overall P&L for the regions. He also heads the project operations and services Pan-India. He's currently on the board of various group companies at DLF. Please welcome Mr. Amit Grover, MRICS, National Director, Offices, DLF Cyber City Developers Limited. The next member of this panel has several years of experience advising major international and domestic companies on a range of tax and regulatory issues pertaining to his specialties. He is presently working with a number of Fortune 500 IT companies on their corporate tax and transfer pricing compliance and controversies. He has significant knowledge and practical experience in the area of cross-border restructuring and business reorganizations. Here he is, Mr. Abhishek Goenka, MRICS Partner and Leader, Tax and Regulatory Services, Bangalore, PwC. An MBA in marketing with strong analytical skills and inherent commercial acumen. Joining the panel now is a thorough professional with extensive experience in business management. Proactive and lucid strategizing are the hallmarks of his operational methodology. Prior to joining RMZ Corp in 2004, he held decisive positions in companies like Bharti Enterprises, Max New York Life, Punj Lloyd, and Colliers International. Please welcome Mr. Arshdeep Sethi, MRICS, MD Development, RMZ Corp. Filling up the final chair of this panel, he has also been involved in advising on setting up a fund formation and several leading real estate investment platforms. He also contributes to policy development for private equity and debt in real estate in India through several international associations and was most recently involved in drafting of the SEBI REITs regulations. He was nominated amongst the top 3 lawyers in India under 35 category at IDEX Legal Awards. Please welcome Mr. Ruchir Sinha, co-head M&A and PE, Nishit Desai Associates. With that, I hand the floor over to our moderator, who will take us through the next 50 minutes.
Thank you. I think this afternoon we have a panel which comprises of developers, a fund, and people on the tax and legal side. So I think we have a fantastic panel who can probably throw more light on REITs and crowdfunding. Let me, come to you, Abhishek, right away. REITs have been, the regulation has been there for some time. In fact, a lot of people are saying when REITs will happen, we will get active again. So what is the, reason why REITs have really not taken off from a taxes standpoint and other standpoint that you have?
Thanks, Sunil. Let me comment from a tax standpoint. I think over the years, the government has listened to whatever feedback was given and many changes were made. But I think there are two fundamental issues that remain. One is the whole tax framework is skewed in favor of non-residents. So when you look at it from a resident investor's perspective or even from a resident developer's perspective, there is little or no incentive and the real pass-through doesn't come through. But at a more macro level and at a framework level, the biggest remaining and outstanding issue is the dividend distribution tax exemption. And that is something which unfortunately the government doesn't seem to be appreciating enough as a reason or as a factor that they need to change, because until that exemption is granted, fundamentally there is a very big leakage. And then we're looking at returns to investors that have to factor that in, and then the whole economics don't work out. And the other thing from a tax perspective is that even if we assume the dividend distribution tax exemption comes through, the whole structure is again predicated on what we call pushing down synthetic debt. So while you may raise equity at the REIT level, you'll have to push it down as debt into each of the SPVs. And particularly where you're already investing in stabilized assets, it's very difficult to restructure the capital to push down debt. There are challenges on the deductibility of interest. So I still think that the real pass-through has not been put in place, and until that happens, at least the tax, from the tax side, it will still be inefficient.
Ruchir, you've heard Abhishek. What's your standpoint? I mean, what should really change for REITs to work? And you've been on the panels, is it working? Yeah.
Yeah, sure. I think there's been clearly a lot of, excitement about REITs. I think it's kind of diminished as we've kind of grown to realize it's not going to happen. But I think there were probably two large reasons for it not to be successful. I think let's talk about tax reasons and non-tax reasons. I think tax reasons were pretty well pointed out by Abhishek. But I think more than that, the challenge that we faced, and we took, we discussed a lot of investment bankers, etc., in trying to compare the Singapore business trust kind of a REIT listing versus, the REIT regulations in India. And as Abhishek said, I think the challenge is that the way the REIT can be made tax optimized is only by pushing in debt. And that debt makes sense only when it is coming in from a non-resident, because it's only in that case that there's only a 5% withholding. If that debt is coming in from an Indian resident, there's a 30% tax that the Indian resident ultimately ends up paying. So therefore, the entire REIT framework or the REIT structure does not make sense for Indian residents. It only makes sense when it is seen in context of non-residents, apart from the DDT issue, which is inherent anyways. Now we said that, okay, now it makes sense for non-residents. There's a lot of interest in foreign investors to invest in completed core assets and yield-generating assets. And India, we have a great yield story, we have a great cap gains story, so please come and invest. But in our discussions with a lot of these foreign investors, what we realized is that there are different pockets of investors looking at different kind of returns. The insurance companies and the pension funds are more yield-based investors. They don't care about the cap gain story. And the Indian yields are not that high, and especially looking at the kind of way our kind of currency is depreciating, it kind of makes people nervous. So yield is not making that much sense. Then we tried to polish our story by saying, yield is kind of low, but you know what, the Indian cap rate story is great. But then again, our history is such that the cap rate story hasn't, how many foreign investors have gotten successful exits and at what prices with the depreciation, everything is, I think, anyways a question. In fact, in lighter vein, someone said that, एक हिंदी में शेर है कि उनके दराज से 4 दिन मांग लाए थे, 2 आरज़ू में निकल गए, 2 इंतज़ार में. So that is how I think the story of the foreign investors have been in India. So the cap rate story does not work. The yield story is not that impressive. In fact, even in the US and all, there is substantial yield, which is pretty much, on dollar-to-dollar base, the US yield turns out much better. So that's one larger commercial non-tax challenge. The other is, in our Indian REIT regulations and, the way we drafted the REIT regulations, and we were pretty closely involved in it, we said that, even the sponsor should have a real estate track record. Just by saying that, you have clearly struck off a whole set of eligible REIT players. The SBI, the Air Indias are no longer eligible to come up and become qualified as a REIT sponsor because they don't have real estate track record experience. That's another challenge. So I think when you look at the holistic picture, there are more than tax. Even if the DDT exemption comes through, I think there are essential non-tax reasons also, which are kind of playing up. Now again, even with another challenge and that kind of developers face, and from their standpoint is that they tend to always compare that should I do a REIT, go for all the listing and all the compliances, versus should I just kind of do an NCD or a CMBS kind of a structure wherein it is conceptually equity or debt, but the instrument is still NCD and I still get deduction benefits. So I think that debate in a developer's mind always continues. So I think there are many issues. And how many grade A core assets do we anyways have, and how many developers and how many assets? So I think there are many more reasons than just tax, which is what we realize. And of course, Abhishek added a lot of them. Thanks.
Okay, so I think the next question is that is there real motivation to do REITs in developers? And we have Vinod on the dais. Vinod, is there really a motivation to do a REIT when you can get a CMBS and then you get a deduction of the interest you pay? So really, it's very cheap debt, and why would you need money otherwise?
No, I think world over it's proven to be a model that's the right way for an exit for commercial real estate and most of the other core real estates in different verticals. It's not yet ready to arrive. It needs to address all of those points that have been raised on the forum today, and there are a couple of other points that need some kind of attention. For example, you're allowed only 10% development potential in your REIT, and then you're going to be structuring down your debt, so you have access to take more debt. You can't take that debt because you can't do much development unless your size is really big. So it's a challenge where you're not efficiently utilizing your leverages to increase your portfolio. Then you have to get a developer to build it for you, and then you buy it out of a developer and list it. So all of those things are challenges, but I think REIT, if it corrects itself in at least half of the points raised, it's a good start.
Okay, Amit, let me come to you. I mean, you are probably one of the largest players in the office space in the country. Would you want to do a REIT yourself, or you would want a sophisticated financial partner with you? What's your take on that? Do you really need a financial partner who kind of has the experience of running, managing a REIT in a sophisticated fashion?
Yeah, thanks. And first of all, I think I would like to start by mentioning that I think although the REIT regulation and the norms have been discussed for more 2 years, although it's not taken off, but the very fact that we still want to discuss, and it's a point of debate, is that there is a core need. If the retail investor has to invest in commercial real estate, the dynamics and the complexities of an active investment have increased over the years in terms of choice of product, in terms of the right location, which cycle, whether it's IT, SEZ, single, what floor size. So by default, the need of a consolidator has further increased over the recent years. Individual active investors who used to invest in a strata sale model have also realized this in the last 7 to 8 years, that there is a fundamental gap in what the strata investment they are doing and what is a tenable grade A asset or a grade A space which a tenant wants. So till such time we get to a solution in terms of giving the right yields and a developer working on the model, I think we would all be working on it till such time the right model is appeared. Then when it comes doing it of your own or with a partner, definitely with an international partner, the experience comes in. The REITs are expected to bring in a lot of standardization, a lot of norms, a lot of regulatory compliances. International partners have that capabilities, have that understanding, and also have a learning curve. So there's no harm being with an international partner in that sense. And at the same time, vice versa, there is also a win-win for an international partner to tie up with a domestic partner, because we know that every state functions differently. The compliances which are required in every state is different. The approval system which is required in every state is itself a process. So it's a win-win as a partnership.
Thanks, Amit. Alok, you again are one of those top 5, honks as we say in the country, who have office space, and you would be, considering a listing at some stage. What kind of returns do you really see in REIT business? I mean, as a foreign operator, you can raise debt at a much cheaper cost, but to an Indian investor, what is the kind of return that you think REITs can throw up?
Yeah, thank you, Sunil. See, in terms of REITs, and when you say that REITs, can it be compared with debt? I would say no, two things are not comparable. While, when we raise foreign debt, the base rate could be much lower, but we have seen in last 5 to 7 years, the total cost of debt, including currency fluctuation, currency devaluation, goes very, very high. We have been looking at rupee and dollar, which was 40 rupees to a dollar. Today it's 70, and now we all agree that this 68 or 70 probably will devalue and move to 75 by probably say this year end or next year. So one thing is foreign debt, it looks nice, 3%, 4%, but overall cost is always higher. It's never less than 12-13%. So that is one. Second thing is people say you can hedge it, but it's not possible. It's very difficult to hedge the foreign debt, and the cost of hedging is again very prohibitive. Third thing is it puts a lot of uncertainty. Your not only interest rates are going up, your capital also. You have borrowed $100 million, which was at 60 rupees a dollar. It was 600 CR. Today that's 700 CR. So foreign debt looks exciting, looks interesting, but it's challenging. So and debt is a debt. So when we look at REITs, any investor in REIT would probably look at 300 to 400 basis point above the GSEC rate. And in India, the GSEC rate is about, let's say, 7%. So any investor who's looking at REIT probably would want a return of about 11 to 12%. It could be a combination of yield, which comes every year, plus the capital appreciation. Anything less than that will not work. And my sense is that, while sometimes in REITs you can get a much higher return, it can touch up to 15%, 16% if the sponsor and manager are performing very well. So REITs is always a more attractive option as compared to debt. It's a debt and REIT is an equity. Second thing is in REIT you have a scalability which you do not have in debt. In REIT you can keep adding assets, you can keep expanding the portfolio, which is a bit challenging in debt. As compared to bond issues also, REIT is much more attractive because it provides a scale and it's an equity and you can keep expanding the portfolio. So REIT is always a more preferable and attractive option as compared to debt, and that's my view.
Alok, fantastic if the investors have a 11% yield. Ashdeep, as a developer, do you think these kind of returns are possible? You would want to kind of go in a REIT situation with that kind of returns to the investors?
So I just said yield plus capital appreciation, and that's where I stand.
Actually, if that's Alok is happy to trade at, I'm happy to make him a public offer to him, So I think we're talking about too early a situation, a little more cynical today. If you look at baby is not born and we're still talking about now having to really engage him in undergraduate school, The first we got tons of issues around on our system where really where is this floating in there. And I think the discussion is predominantly only a taxation side, and I think I've shared dais with Ruchir and Abhishek many a time. It's only a taxation discussion. We still haven't talked about a business. So today, if you look at REIT, actually it's become an instrument for a taxation discussion rather than having a business view to it, Unfortunately, the sheen to business is really lost, I mean, the very fact, the way it needs to be implemented, the way people have seen as a fundamental change in a business is probably lost its sheen. But having to answer your question on that, I think it's relative in terms of the yield that you talk about because it has many other factor to that. Factor the regime, which is the interest regime in the country today. Very importantly, in our country, the yield has probably a misnorm to it, because don't forget, we've got inflation which is going in there in our country. The replacement cost has an impact to it, Third, obviously, the interest rates is obviously fluctuating and is tapering down, So to fix on a number, I think is very difficult. But in my assessment, anything which is mid to low, mid to high single yield, I think would really excite people to go in there. You know, the numbers that Alok talked about, I think are quite appreciated. But today, if you look at an LRD, CMBS, you know, it's all trading at today at single digit. You know, so if the capital is available on a safe haven of a commercial real estate, which is AAA asset, AAA client, and have a visibility for next 12, 15 years, you would rather raise money on that. But I think that's not addressing the REIT objective, you know, because the REIT objective is very simple, is really is to recycle the capital. And unfortunately, in this situation, it's not recycling, this is only circling the capital, you know, because end of the day, you're raising LRD or CMBS, you know, there has to be a liquid instrument available for investors to really trade in, to come in and actually exit at an appropriate time required and actually allow us to raise more capital on that. So unfortunately, that basic objective of REIT somehow is lost in a whole discussion of income tax, DDT, and stamp duty, you know, and I think the very essence to me is really baseless today.
Okay, let me come to you, Abhishek, and then, I think all the panelists can attempt at that question. We have an AIF regulation which is already in place. Recently, the government has allowed FDI funding into AIFs that have been set up. So, isn't that an attractive mechanism to attract capital? And REITs, while they can come and, they can take a time. What's your standpoint? Is that a better mechanism? And, how do you see that regime?
So I'll let Arshdeep and the other developers and funders talk about it from a business perspective, Sunil. But and Arshdeep, I agree with you that I think tax has taken the limelight on REITs for far too long, and it's time to move on. But on AIFs, Sunil, as you rightly pointed out, I think the recent changes on the FDI side are fairly sort of game-changing in that sense, and at least it now takes away this whole, in a sense, artificial debate that, can you have a mixed pool of foreign capital and domestic capital, and, does it still get subjected to FDI norms? So in certain situations where the asset manager is Indian owned and controlled, now the regulations make it, clear-cut that an AIF can have as much foreign capital, there is no limitation, and the FDI rules will not apply to it. So from that perspective, the change has been made in the REIT regulations also. So to, purely from an FDI perspective, REITs and AIF now stand on the same feet, and therefore there is no FDI advantage on the AIF side as compared to REITs. But I think the taxation regime in AIFs is much more straightforward because they're structured as a trust. And in that sense, there is a kind of complete pass-through given to AIFs, and therefore the investors are better placed from a pure tax perspective as compared to REITs. There are still some open issues in the AIF framework also. I think the 1 crore ticket size is something that we should debate as to whether that needs to come down a little bit, because that in my mind does come as a deterrent in terms of actually attracting retail investors.
I think this is a very good point that that 1 crore ticket size has definitely been a deterrent because AIFs have gone out and there is very little sophistication in the intermediaries as well to raise that kind of capital. But my question to you, Ruchir, will be that while the FDI regulation, so anything which is under, if the AIFs have a waiver on the fact that this is an FDI and this is like a domestic investment, can you use that to really say that AIFs can be REITs?
I think obviously AIF and foreign investment into AIF, I think, is a major game changer, because so long as your sponsor and your GP or your investment manager is an Indian resident, that AIF becomes an entire Indian vehicle which is not subjected to any kind of FDI restrictions. So I think it's clearly, a major game changer, especially for Indian GPs who used to Vikas is not here, but I think for the Kotaks and the India REITs, set up offshore vehicles, pool in offshore money and all that, and run the risk of now POEM risk, GAR risk, and I think the tax structure and everything becomes very, very simple, right? But I think just to add on, one of the challenges from a tax standpoint is that whenever an AIF distributes to its non-resident holders any amount of income, there is a 10% withholding tax, which would not have been there if there was, let's say, an offshore fund which was directly investing into an Indian company from Mauritius or Singapore. So to that extent, there's a little bit of arbitrage, but at least my experience has been people don't mind paying taxes. People just want to pay tax and have a comfortable night of sleep, you know. The problem in India is that you don't get it. So I don't think that this 10% arbitrage will kind of, you know, create much of a challenge. But I think on the, so this is a structure which I think is clearly being evaluated by many of our clients, and increasingly developers are also becoming, you know, fund managers. Godrej has just started its Godrej fund management arm. We're helping them do that. There are many others who are also looking at fund management. I think for them to tap an offshore capital will become a lot more easy. To answer your question, whether you can actually whether an AIF can actually evaluate a REIT model, I think there will be a couple of challenges. I think the first issue is that, you know, if there's 1,000 crore single asset, today a REIT is not required to diversify as much. But in an AIF, you must have at least 4 assets, because more than 25% corpus cannot be invested into one asset. To some extent, I think it's good to pitch for lowering the limit of 1 crore to 25 lakhs. I think we, through many associations, pitched a lot when, you know, when VCF, or the venture capital fund regime, was replaced by AIF, because a lot of our clients who were tapping retail participation 25 lakhs then under the earlier VCF regime lost a lot of their investors because it became 1 crore. But I think based on at least on our interactions with, you know, SEBI, etc., I think AIF was always intended to be a more sophisticated platform for sophisticated investors, and therefore 1 crore was a degree of sophistication, and lowering anything would in their minds be a kind of a systemic risk. And I don't think that will be allowed, and, you know, so they'll come back and say, you know, you have the REIT regime for it. So you tell us what you need, and, you know. So I don't think that REIT and AIF can actually kind of be be substituted. But I think in the way the AIF regime has been changed, I do think that there will be a lot of foreign capital, and you know, which is already happening in non-real estate classes. A lot of foreign capital can be tapped and used up in extremely tax-optimized manner. In fact, I don't know, Abhishek, we should probably debate upon it separately, but we should see if, you know, even capital gains benefit can be adopted, because ultimately the trust or the AIF is only a pass-through. So if there is capital gains eligibility for the offshore investor, maybe we can make a claim that there should be no tax withholding at all. But unfortunately, you know, that is dependent on the trustee and the fund manager. But I think that's a very good route.
Okay. Let me quickly, you know, add one comment that I have, that is regulator missing something? VCF had a 5 lakh rupee limit. It was raised suddenly to 1 crore, thinking that this is more a sophisticated investment. Now in REITs, we see the ticket size is only 2 lakhs. And, you know, while this whole REIT, you know, model will be played out in the country, is it not better at this point in time to have an investor limit to 25 lakhs or more sensible, and then reduce it to 2 lakhs? What's the standpoint of, let's say, developers here? Amit, what do you think?
Actually, to really gain a wider acceptability, there's no harm having a lower limit. Because I said that unless you don't spread the base, it's all linked. If it's well-regulated money, there's no harm having a wider base. I think what's also important is that, while we are discussing the yield from the business point of view, going forward, there are good indications that the business will go well. Probably last 2-3 years, we are totally talking about the yield from the existing assets which are already rented out. Not many new developments have rolled out. I think going forward from this point onwards, with the new developments coming in, the net ROI would increase. And that will add to the existing dividends which the current rental yielding assets in the current portfolio is. So I see no harm, as long as it is well regulated, to have a wider base and a good lucrative, lower investment entry point.
Anybody on the panel tends to differ on this? Alok, Ashdeep?
Sorry. Yeah, so my view is that REITs and AF are two fundamentally very different instruments. And while AF, there's no liquidity, REITs have a liquidity. That's a one big game changer. Second thing is, AF, all said and done, is a kind of a privately held, closed money, and the level of disclosures are not all that high. Whereas REITs, being a listed instrument, will have a very high level of disclosures. And also the REIT regulations kind of mandates or kind of ensures that, fringe players will not be able to kind of go and kind of do a REIT listing. So only the good quality players will be able to do a REIT listing. So from that perspective, I think 2 lakh limit per person is just a right limit, and we need a wider participation. You know, I think two are very, very fundamentally different instruments, and 2 lakh limit is just fine. That's what I feel.
Okay. Uh, Typically, you know, when you look at REITs globally, there have been operating assets in REITs, and you know, you have. In fact, there was a professor in the school who recently, you know, has done a lot of work on U.S. REITs, and he said prison REITs in U.S. were performing the best. So government actually doesn't want to invest in prisons. They want them to operate prisons, and more people are, you know, required to be put in jails. I think that's U.S. Still law and order there is not all that right. So very interesting, you know, statistics that you had office REITs, hotel REITs, and car parks, etc. But the highest yield was prison REITs. Now, in the current regulation, there is no provision for an operating asset and operational income to kind of drive the yields up. You may have a business cycle where some of these operating assets may perform better. And also, so the first question, you know, to all the panelists, and I think we can go one by one, is that should there be operating asset also allowed to get into REIT? And two, that, you know, if you look at US REIT markets, they have mortgage REITs and they have equity REITs, which means that I can invest into a REIT instrument purely from a standpoint of getting rental income. Rental income in case of equity, and otherwise I can give money to the REIT purely as a debenture, purely for the gain as an interest. So what's the take? I mean, should really this be allowed? And we'll start with Abhishek and go towards the panel.
So on your first question, Sunil, on operating income, I mean, to my mind, it goes a little against the grain of a REIT. I mean, the fundamental concept of a REIT is that, you know, it is the real estate asset which should be driving the returns to the investors or to the lenders for that matter. And therefore, the operations just by structure ought to be kept out. And at least in the Indian context, I don't know if that is really a big ask even from the developers, because, you know, when it comes to an office asset, that the basic operation and maintenance can remain in. We're only looking at, let's say, if you look at education REIT, then, you know, you can't have the actual school operations sitting in the SPV, or you can't have the actual hospital operations sitting in the SPV. So when it comes to the core asset classes like a mall or an office space, I don't think there is any major dichotomy. It is only when you look at some of the alternate non-traditional asset classes. And even there, I think just based on how the regulations are, I don't see a big dichotomy if the operational part is left out. Of course, it creates a lot of structuring issues, because today, if you look at all the educational institutions or most of the hospitals, they're all structured as single entities, and therefore for a REIT to come in, you necessarily then require unbundling and, you know, creating the OpCo-PropCo models, which have a lot of challenges. So, but I think that's something we'll have to live with. To your second question, the Indian REIT regulations already allow debt at the REIT level, but I think again, just to give my comments from a tax perspective, the whole framework is very heavily loaded in favor of non-residents, and I don't necessarily have a problem with that, because non-residents can get away with a 5% withholding, which is really the lowest possible under any treaty or even under any provisions of the law on debt that they give to a REIT. But I think that's not, again, enough to attract debt at the REIT level, because ultimately that needs to be pushed down again as debt into the asset SPVs. And to me, that is going to be the biggest challenge. I mean, as advisors, we all come up with structures, but you know, the reality of it is that many of those structures are short-lived. Many of them have issues. There are challenges on deductibility. So really the 5% is never really 5%, because there are a lot of inefficiencies and leakages through the chain.
Okay, what's your take, Alok? You kind of internationally, do you have operating assets and REITs?
No, so I won't know that. I mean, so that's something I'm not aware. So my take is it's a bit too early. I mean, we have been talking about REITs for the last 3-4 years, and nothing is materialized. So it will be good to move into steps. And I don't even think if REITs come through, we are able to solve out tax issues. Let's look at one fact that, you know, all real estate developers have an opportunity to do IPO, but they have outpriced themselves from IPOs from last 7 years. No real estate developer can think of going for an IPO, because, you know, they have outpriced themselves. So my sense is let's move stepwise, and I think first let's do core assets, let's go through some learning, and then probably we can think about operation assets. That's my sense.
Ashdeep?
I think I kind of agree with Alok on this. It's too early to discuss all these subjects, you know, and I think we should have a baby steps to begin with. And I think the first baby step is to see that the current discussion on REIT should muster pass and gets an attention from us. And I think the proof of really pudding is to have few companies getting onto this, because what you're saying on the operation side, I think is a stage 2 of our discussion. I mean, Relegate did that, you know. I mean, when they did the real estate in REIT in Singapore, they actually only have the real estate being actually listed, you know. The operation still continues to remain outside that, you know. So I think, to me, that's a second situation, but I think, and that's probably a little far at this stage, you know.
Vinod, you're already nodding your head in affirmation to what Ashdeep said.
Absolutely. See, what's more relevant is not listing a REIT, it's about managing a REIT, and the premiums that you will get for your REIT will be determined by the governance levels you bring in, the quality of asset management, the quality of your tenant portfolio, the appreciation of your asset over the long term, the markets you choose to be in. All of those factors will drive your value of your REIT. And obviously, those will differentiate A REIT from B REIT, etc. So all of those points can come way later in the cycle. After you actually established, delivered dividend, worked through the structure, understood the nuances of the new legislation. Is going to take 2-3 years to iron out most of the folds, and then you would really know how the legislation needs to go to the next level. So we are a little early to discuss everything else, because we first need to prove that the REIT model can function in a mature fashion in India.
Amit, DLF has been in the office space for very long, and if I read correctly, we have another professor at the school who probably said that DLF was the first company that set up a full-fledged asset management concept. In fact, facilities management growing into asset management. So, you know, we've all said that, you know, high level of governance, etc. So what are the challenges, and how has, you know, DLF tried to look at their asset management piece internally, and how do you look at that adding value to a REIT?
Yeah, so whether as a listed company or preparing for REIT or anything which has external regulated accountability, the whole organization has to be structured accordingly. It has to be a board-run company. All the important positions have to take accountabilities of compliances and adherence to all the laws. Whether if you bring in your external partners, their contracts and SLAs also have to be aligned in line with the regulations which is expected from a regulatory authority. And also what is most important is the whole culture of the organization has to change. It's not just what you do on papers, it's like walk the talk. So your on-ground operations have to completely go for a change. You cannot just claim a zero incident or over a 3 years or a 4 years. That comes with a lot of safety practices on ground. Your entire approach to when you're devising a construction cost, are you putting in a budget for safety? Are you putting in a budget for the safety officers? Are you giving time for compliances? Are you starting with all the approvals in place and the detailing by your project manager completely in place, so that anything which leads to a shortcut and leads to any exposure or a risk, that's kind of it's a DNA change what you do in an organization. So I think any kind of institutional money, REITs or private equity which comes in, this would be the fundamental parameter, because all these investments are meant to be passive investments. They want returns. They want growth, but no risk. So that's been very clear.
Okay, Ruchir, looking at the regulation itself, and for one moment, let's put the tax aside. Let's put the other. From a small investor perspective, how safe is this regulation? Do you really think this regulation that's been brought about, does it really protect the small investor?
The REIT regulation.
The REIT regulation.
Yeah, I think it's more safe than it probably should have been. Right. So, for instance, it says sponsor must have a real estate track record. Nowhere is a sponsor required to have any track record. A sponsor is nothing else but a mere anchor investor. But in REIT regulation, we said the sponsor must also have a track record. I think the the tests for related party dealings have been pretty high, which kind of make it a bit of a challenge to kind of put in single tenanted assets into a REIT. So I think we have treaded a very cautious path in ensuring that the retail investor is protected. And I think somewhere down the line, some of these things need to be relaxed a little. Because I don't think that in the first set, you will ever have retail investors participating. I don't think retail investors will ever understand it, and I don't think retail investors will make the market for it. I think to start off, this will largely be institutional players with institutional assets being thrown in. And for that matter, I think there needs to be a little bit relaxation, which I was initially not very favorable for. But now the way I've seen them shape up, I feel there's a bit, I think there's a need for a little bit of relaxation to kind of get the ball rolling at least. You know, there should be some kind of market for monetization of core assets which have been languishing for a while. Otherwise, even today, people will look at listing on the Singapore Stock Exchange only and nowhere, and Indian capital markets have anyways been exported to India. And I think the way it keeps going, I think even you would not see any Indian real estate listing, and I think people are still contemplating actually SBDs figure out better for us, for the listing of real estate than Indian assets. So I don't want that. I think once there is some kind of traction in the market, I think then you can really look at, kind of tightening the noose and all that. But at this stage, I think probably there's a need for soothing things up more than for players.
Okay. Let's touch on crowdfunding. I mean, the whole thing is that crowdfunding is getting very popular globally. What I read of regulation, at least what the consultation paper that was submitted to SEBI, is that real estate is not even part of crowdfunding. So you cannot, as a real estate player, go and seek crowdfunding. Is that correct reading, Abhishek? Is that reading correct?
Yeah, that's correct, Sunil. So the consultation paper excludes real estate specifically, and of course any other sector that is not a permitted activity under the industrial policy. Although the sort of whole reference to the industrial policy is slightly dated, but more specific to the conversation and debate that we're having now, real estate is specifically excluded. But at the cost of, making a contrarian statement, I don't really see that as a big deterrent, because to my mind, I don't know if crowdfunding is really, the solution for real estate developers. Just as a concept, it is meant for startups, for smaller companies. So it's not just a real estate sector exclusion, even there are other exclusions that will come in the way. It says it cannot be a company promoted by a group which has a turnover of, I think, more than 250 crores. So most large developers will get excluded. So I think just in concept, anyway, the country is still not ready in my mind for crowdfunding, even for startups. But certainly, I don't think the real estate exclusion is a big deal. There are lots of other battles to fight for us.
Okay. Before I open this to the audience, one question that I have, and to the developers on the dais, is that this has been often debated that real estate should be given an industry status. The other argument that has been used is that IT as an industry flourished in this country only because it was never given an industry status, and therefore the red tape was cut out from it. So very quickly, Vinod, do you really, would you bat for this real estate to really get industry status?
Yeah. Not really, because residential real estate you can't really give an industrial status to. So yeah, you may look at IT parks as an industry status. It might ease out of some of your approval processes, but otherwise those days are gone where you really saw the difference between the two. So it's actually, it's fine if it's not there or there. It doesn't make much of a difference.
Okay, Ashdeep?
I think a few benefits, as one Vinod talks about on the approval side. And second, I think I would say is that if such provisions available, then the instrument like ECBs, etc. are possible, And although, as Alok rightly said, in the current situation, I'm not too sure that's probably the best way to really raise the capital. But having a little more non-volatile market, more stable, if such status can help in approvals, and plus maybe a cost of capital for deployment maybe a little cheaper.
Any view, Amit, on that?
Well, actually, over the years, SEBI has upgraded a lot of compliance requirements. So there is already a visible, domain on which the industry has to operate.
Now you have real estate regulatory bill stepping up. I think there is enough parameters compared to 7, 8 years before than the industry has today, which protects or intend to protect both the retail investor as well as institutional investor. Definitely, the real estate bill has to be debated a bit more vis-a-vis the reality of on ground and how the developers have kind of aligned their projects. So I think between real estate bill and the SEBI norms getting strengthened, that should be good enough to kind of do the job.
Alok, one question. I'm very tempted to ask this to you. You know, you tour globally and you see the REIT scenario. Most of the REITs are now batting to say that we will become developers. So a lot of these REITs in the US are large REITs, and most of the REITs are trying to say that give us a little more than 10%, make it 25% of the corpus that I can invest into development. Purely that you are a financial house, you've bought a large asset. Do you think that at some stage you will have a developer hat also?
So, yeah, interesting. Actually, we have bought a large portfolio and we are operating as a developer right now. And we have spent a lot of time, a year back thinking whether we should come here and work with a partner or whether we should kind of operate independently. And the challenge in operating independently was primarily from compliance point of view, to be on the right side of law and still be able to develop. And after almost a thought of 2 months, we thought we'll probably go alone, we'll not partner with anybody, because the challenge in partnering with everybody is very, very difficult to get an alignment of minds. It's very difficult to make your partner work or think the way you are thinking actually. And it has not worked in last 7 years. Funds and developers, their minds have not met. Only they have met at the time of when the deal is closing. Afterwards, I don't see they see eye to eye on anything. So we have taken a conscious call that we want to have a development hat, and we have created an operating team, and that is the way we want to operate, and that's what I think we would prefer.
So very interesting. I mean, grass is always greener on the other side. You have developers who are saying we want to become REITs and we would want to partner, but then the partner is saying, sorry, the marriages in past have not been successful, so we would want to go alone. So on that note, I would like to open this forum, and if there are questions in the audience, please raise your hand, introduce who you are, and address the question to a specific panelist or in general. Any questions? So no questions by the audience. I think either we've done very well or we've made you all go to sleep and you're waiting for the tea to be tea being served. So very quickly, I'll just try and conclude what we've discussed. One is we've all said that regulation itself, which is a tax regulation, is a big stumbling block in REITs, and unless that gets sorted out, it is very difficult to even conceptualize the envelope within which the REITs will operate in this country. And, Ruchir pointed out a number of issues, and so did Abhishek, saying that today the REIT is more favorable to an NRI investor than a domestic investor. I think that's something we, know. But on the yield side, I think the yields that at least the US market gives is in the region of 13–14%, where 7–7.5 comes by way of yield and the other by capital appreciation. And this is an average figure across US, which is fantastic. We haven't heard those kind of yields, and then obviously there is a problem with currency depreciation, etc. So I think for a foreign investor also to look at REITs is only by way when he levers his funds outside the country and then kind of takes a call. Again, there's this huge issue which I think Ruchir brought out, that a lot of corporates which have classically held lots of real estate. You have Air India, you have a lot of behemoths who have lots of real estate, and I think that was a low-hanging fruit if you were to really ask me, because the cost of the asset was almost next to nothing, and they would have actually used that to kind of get a lot of money on their balance sheet. But that's not allowed. So I think regulation, again, is coming somewhere in the way of this whole regime to be implemented. Again, there are lots of people who also are interested in REITs. They may be institutional, they may be retail investors, but as and when the regulation pans out, I think then only the fine print and everything can be discussed. So in conclusion, I think this has been a debate that's been going on for 2-3 years, but it still is a debate, and we really haven't made any progress. So any panelists would like to add and conclude before we kind of end the session? Thank you very much for hearing us patiently. I think the tea is being served outside, so after this, you all guys can move into the tea session. Thank you very much.
Thank you. That's half my job done. Thank you very much. Before you go, may I request you, sir, to please present mementos to our panelists. First to Mr. Abhishek Goenka. Ladies and gentlemen, those of you who are running away for tea already, we'll meet back here in 15 minutes for the final session of the day. Mr. Ashdeep Sethi, Mr. Alok Agarwal, Mr. Vinod Rohira, Mr. Amit Grover, and Mr. Ruchir Sinha. Could I request Mr. Alok Agarwal to please present a memento to Mr. Sunil Agarwal? Thank you.